Hello, can you hear me? Am I audible? Just give me a yes if I'm audible. Hello and good evening, guys. I hope my voice is audible. Let me also check voice. So yesterday we had done up to the chapter uh, dividend. We are done up to the chapter dividend, and today we are going to discuss the rest of the questions in the Super 30. Yesterday we had already covered what do you say? We had covered till question number 16. So from 17 to 30, we'll be discussing today. A couple of questions like yesterday, I wrote the answers. Today also, I'm going to write the answers. But a couple of questions. Uh, Good evening. Good evening. I just hope the voice is right. Huh? A couple of questions like yesterday we had done a direct questions. Those we will not do, but otherwise the rest of the questions, I mean, those we will not write like yesterday, but as we did yesterday, the same thing we'll do today also. Okay, I want you to please read this question. Like yesterday, I'll still ask you only to first give me the answer and then I'll give the answer. That works with everyone, right? Yes. So I want you to please read the question, give me the answer, and then we'll discuss it. Let me also just open it so that. Just 1 second. I'm trying to. It's not being only here. I've got it now. Yes, please tell me. Okay, like yesterday, as I was asking you the answers, please tell me. Read the question, tell me the answer, and then we discuss. The Income Tax Authority has gathered some information and is of the view that there has been a manipulation of accounts of FGH Limited reflecting an incorrect financial position of the company. The statutory body intends to get the accounts reopened to reflect correct financial position of the company. In light of the Companies Act, elucidate the statutory provision governing the governing the reopening of accounts by the Income Tax Authority, the voluntary revision of financial statement or board's report by the directors. For how many preceding financial year the board of directors may revise the financial statement? Tell me, what all will be the answer for this? Please tell me. Can I say this is section 130? This is section 131. Can I say this is section 130 and this is section 131, right? Just logged in. So basically, if the Income Tax Authority wants to get the books of the company reopened, then in that case, this is basically section 130. And what section 130 says is that the tribunal, first of all, a company cannot reopen its books of accounts unless the order is given by the tribunal. The tribunal can give the order for reopening if an application is made to it by the central government or the income tax authorities or SEBI or any other statutory regulatory body or any other person concerned. If the tribunal finds that the books of accounts are manipulated, that is, they are drawn fraudulently, or the management is the way the management is working, it casts a doubt on the reliability of the financial statement. Then, in that case, the tribunal will order for the reopening of the books of accounts. But before it gives an order, it will send a notice to all the authorities, income tax authorities, SEBI, central government, statutory regulatory bodies. It will give a notice that if you have any representation, you can make. Once that is done, the tribunal will pass an order for the reopening of the books of accounts and the company can reopen. When the tribunal gives an order for the reopening of the books of accounts, the maximum years for which it can reopen the books of accounts is 8 years. However, if investigation is going on and the company has been ordered to open the books for a longer period of time, in that case, the books will be open for a longer period of time. This is the first one. Section 131 says that if the company or the directors of the company is of the opinion that the books of accounts of the company has not been, that is the board's report is not in compliance with section 134 and the financial statement is not in compliance with section 129, then they can apply for revision of the they can apply to the tribunal for revision of financial statement or the board's report. Now, when they apply for the revision of the financial statement or the board's report, what will happen is they have to, they have to give a notice, an application to the tribunal where they will specify the reason they want to reopen, the name of the directors and the, managing directors and details of the CFO, chief financial officer, the directors. If the books have been audited, the name and address of the, and the contact details of the auditor, then in that case, if the majority of the directors and auditors of the company has been changed in the recent time, then that information also has to be provided. At least 14 days before the application to the tribunal, a notice has to be published that if anyone has any objection, they can raise objection. Tribunal will give the consent. Once the consent is given, I'll call a meeting and pass a resolution at the meeting. Only if the approval is given at the meeting, now I can reopen the books of accounts. This is voluntary revision, which is given under section 131. Always remember, revision of books of accounts cannot be done for more than 3 financial years. Voluntary revision under 131 cannot be done for more than 3 financial years, and it can be done only once in a financial year. I hope this is clear to everyone. Since it's a very, very direct question, I'm not writing it. I just wanted to discuss basically the provisions here. Okay. This is a very interesting question. I want you take your time and I want you to give me the answer to this, please. Please give me the answer to this question. Then I'll work it out. Like yesterday, you guys were answering. Today also, I expect you to answer. Delta Flight Simulators Limited, a listed company, incorporated on 1st April 2020, has given the following information. CSR committee will be required, sure. Okay. Anyway, profit after tax is only this much, and we take profits before tax. So, in the preceding year, so CSR committee is needed. Okay, fine. Let's read it. Delta Flight Stimulators Limited, a listed company incorporated on 1st April 2020, has given the following information. So what information is given? They have given the following information: equity share capital 100, equity share capital 100, then the preference share capital, general reserves, revaluation reserve, revenue after operations, profit after tax, tax on gross profit. Do we take, first and foremost, do we take profits after tax or do we take profits before tax? Tell me that. Do we take profits after tax or do we take the profits before tax? Do we take profits after tax or do we take profits before tax? No. No, actually we take before tax. We take profits before tax. Generally, if you will see, if you get a question where both is given, please try your calculations on profit before tax and not after tax. So, due to oversight, the company has neither constituted CSR committee nor spent any amount on CSR activity for the last 3 years. You are required to compute the eligibility to constitute a CSR committee. Okay, first of all, when does CSR apply to you? If your turnover is 1000 crores or more, or your net worth is 500 crores or more, or your net profit is 5 crores or more in the immediately preceding financial year, you have to constitute a CSR committee. What is the CSR expenditure? CSR expenditure, however, if your total expense does not exceed 50 lakhs, you don't have to constitute a CSR committee. Further, the amount of expenditure is 2% of the average of the profits of the past 3 years, net profits of the past 3 years. If the company has been incorporated for less than 3 years, then the average of the profits of the number of years the company has been incorporated. Can I say this? Yes. Now, acha guys, tell me one thing. Can you actually find out the net worth also here? Can you also find out the net worth here? Can you find out profits before tax? In this case, can you find out profits before tax? Hello? Can you find out profits before tax? See, they have given you the tax rate, right? I want you to find out profits before tax. Please calculate and tell me. Can I say 30% of 70%? Yes. Can I say 30% of 70? 30% of 70, 30% of 140, 30% of 210. That added will be profits after tax. Sorry, before tax. Am I right? Hello, hello, hello. Am I right? So 30% of 70 will come up to what? 21. Right? 30% of 140 will come to how much? 42. 30% of 210 will come to how much? 63. Right? This is the profits after tax. Now, what does the act says? As per section 135 of the Companies Act 2013. Am I right in my profit calculation? Am I right in my profits calculation? As per section 135 of the Companies Act 2013, every company having in the preceding financial year or net worth of 500 or more in the preceding financial year, or net profit of 5 crores or more in the preceding financial year must constitute a CSR committee comprising of what? 3 or more directors. If the total amount to be spent does not exceed 50 lakhs, the company need not constitute a CSR committee. The total expenditure under CSR shall not be less than 2% of the average of the net profits in the past 3 years. If the company has been incorporated for less than 3 years, the average of the profits of the years it has been incorporated for. In this case, the net profit after tax is 210 crores and the tax rate is 30%. So, net profit before tax is 210 crores plus 30% of 210. Am I right in this calculation, guys? At least yes or no to bol do kam se kam. Am I right in this calculation? Which is 62 crores plus 210, which makes it to 272 crores, right? Since company must constitute a CSR committee. The CSR expenditure for financial year 21-22 shall be 2% of the average of the past 3 years. Since company is incorporated in 2020, it will be 2% of average of profits of 2021 and 21-22. 2% of profits for 2021 is 70 plus 30% of 70, which is equal to 81 crores. Profits for 21-22 is equal to 140 plus 30% of 140 plus 42, which is equal to 182 crores. 2% of 81 plus 182 divided by 2. How much will it come to, guys? Whatever is the figure. Contribution for 2022-23, 2% of 81 plus 182 plus 272 divided by 3, whatever is the contribution. I hope this is clear to everyone. So now please give me the answer to this question. Give me the answer to this one. Okay, when does a company need to have an internal auditor? Either the company is a listed company, or if the company is a public company which has a paid up share capital of 50 crores or more, or which has a turnover of 200 crores or more, or outstanding borrowings from any bank or financial institution exceeds 100 crores or more, or deposits of at any time is 25 crores or more, the company must have an internal auditor, right? Here, if you see, KSR Limited is an unlisted company. So if it is a listed company, doesn't matter what is your paid up capital, whatever, you have to have an internal auditor. But it's an unlisted company. So what was we have to check the four limits. Paid up capital 50 crores, it's less. Turnover 200 crores, it's less. Outstanding loan from bank, right, was 105 crore, 110 crore loan obtained from bank, and the outstanding balance on this 90 crores after repayment. They are saying that even on a single day, if this happens, right, even on a single day, if this happens, you have to appoint an internal auditor. Here, as of today, the balance is 90, right? But somewhere during the year, it was 105 crores. Am I right? Somewhere during the year, it was what? 105 crores. So that means you, even if it is for a single day, you have to appoint an internal auditor. So is the company required to appoint an internal auditor? Yes. So this is given under section 138, read with rules, right? Actually, section just 138 just says class of company specified. It's actually given in the rules only. Read with rules. Read with rules, and every unlisted public company having first paid up capital of 50 crores or more, or turnover during the preceding financial year, or turnover of 200 crores or more during the preceding financial year, or outstanding loans or borrowings from any bank or financial institution exceeding 100 crores at any point of time during the preceding financial year, or outstanding deposits of 25 crores or more at any time during the preceding financial year, right, must appoint an internal auditor, right? Must appoint an internal auditor. Now, here, this is within the limit, this is within the limit, but 110 crores loan was obtained from the bank. Outstanding loan on this date was, even if one day also you have this limit, you have to. So here, since the limit is already crossed, sorry, is the company required to appoint an internal auditor? Yes, the company is required to appoint an internal auditor. Okay. Moving to the next one. The next question. The board of directors, the board of directors of Mines Limited, a listed company, appointed Mr. Guru, chartered accountant, at its first audit as its first auditor within 30 days of the date of registration of the company, to hold office from the date of incorporation, date to the conclusion of the first AGM. At the first AGM, Mr. Guru was reappointed to hold office. Mr. Guru was reappointed to hold office from the conclusion of the first AGM till the conclusion of the sixth AGM. In the light of the provisions of examine appointment of Mr. Guru by the board of directors, reappointment of Mr. Guru as the at the AGM. First of all, in case of first auditors, other than that of a government company, the first auditor shall be appointed by the board of directors within 30 days of appointment. Correct? Second, when it comes to reappointment of Mr. Guru, for subsequent auditors, the auditor has to be appointed by the company at the AGM. And this auditor shall hold office from the conclusion of the first AGM to the conclusion of the sixth AGM. Doesn't matter whether it is the same person who is appointed. If the appointment is made at the AGM, the appointment is absolutely valid. Since here Mr. Guru was actually appointed at the AGM, the appointment is absolutely valid. So it doesn't really matter whether the appointment is of the same person who was the first auditor. So the appointment is absolutely valid. So here we have to write about the appointment part, section 139. As per section 139, of the Companies Act 2013, except in the case of a government company, the first auditor of the company shall be appointed by the board of directors within 30 days of registration. Such auditor shall hold office till the conclusion of the first AGM, right? Till the conclusion of the first AGM. Now, what will happen subsequently? Every company shall, at the first AGM, appoint any individual or firm as an auditor of the company. The person so appointed shall hold office from the conclusion of the first AGM to the conclusion of the sixth AGM and every sixth AGM thereafter. Right? Every listed company and other company specified shall not appoint an individual for a term of 5 years or firm for 2 terms of 5 years each. Correct? So this is my provision. This is my provision. So appointment of Mr. Guru by the board of directors, yes, it's valid. Appointment of Mr. Guru, yes, it's valid. And Mr. Guru shall hold office till the conclusion of the sixth AGM. And if it is a listed company or the specified companies, then it cannot hold the office beyond that. In that case, he will have to have a break of service for 5 years before he can be reappointed. Okay. A be an associate ABN Associates, a firm of CA, was reappointed as auditors at the AGM of X Limited held on 30/9/2019. However, the board recommended to remove them before the expiry of the term by passing a resolution. Can I remove an auditor before term? Yes. Under section 140, I can remove an auditor before term. But for that removal, I need to pass a special resolution. Plus, I need a what? Prior approval of central government, right? Subsequently, having given consideration to the board recommendation, they were removed at the general meeting by passing a resolution subject to the approval. That means they have not taken the approval. They have removed them on the condition that we will take the approval of the central government. But we have seen that the act says that in fact the whole point is that first the board resolution is passed for removal, then we apply for approval from the central government. If we get the approval, then we pass a special resolution to remove the auditor, right? So here they are trying to remove the auditor even without getting the approval of the central government. So is this removal valid? No. So as per section 140 of obviously the Companies Act, an auditor appointed under section 139 may be removed from his office before expiry of term by passing a special resolution after previous approval of central government, right? So the company must first take the approval of central government, and then pass a special resolution after giving the auditor an opportunity of being heard, right? Now, what happens is basically you pass a board resolution, right? You pass a board resolution that you want to remove the auditor. After that, you file an application. Within 30 days of the board resolution, you file an application to the central government in ADT2 that I want to remove the auditor. Once central government gives us the approval, within 60 days, we pass a special resolution to remove the auditor. So this is the procedure that you have to follow. Here, you have passed a special resolution without getting the approval of the central government. So obviously, the removal is not valid. So anyway, let's write it down. The following steps should be followed. The following steps should be taken for removal. The company must pass a board resolution within 30 days of board resolution. The company must file an application to the central government for approval in ADT2 within 60 days of approval of central government. The company must call a general meeting and pass a special resolution removing the auditor, right? In the instant case, the approval of central government was not taken, and hence the removal of the auditor is not valid. In the instant case, approval of central government was not taken, and hence the removal of auditor is not valid, right? So we are done with this. Moving on to the next one. Okay, this is an amazing question. Want you to go through it before we discuss, and if you can give me the answer, just give me a minute. I forgot to get my charger. Will die here. We should try and give the answer before we discuss. Very, very interesting question it is. So let's see what the question says. Let's see what the question is saying. Chicago Bricks Incorporation is a company incorporated in Chicago. So that means it's a foreign company. USA in the year 1985 engaged in the manufacture of cement and related products. It commenced manufacture in India through its branch engaged in the manufacture of fly ash bricks used in construction of buildings and other infrastructural projects throughout the country. The operations of the branch have been growing at a fast pace. The turnover of the branch is this. As per the data available, the branch works based on 20% net profit margin. That means they have not given us the profits, but they have given us the turnover and they have given us the profit margin, right? They have given us the profit margin, which is 20%. Mr. Ramesh, one of the directors, Mr. Ramesh, one of the directors of Chicago Bricks, has advised the branch to comply with the requirements of CSR and to form a CSR committee as well as for monitoring the aforesaid activities for the financial year 25-26. The branch is opposing the above view and has submitted that although the CSR provisions are applicable, are the CSR provisions applicable? CSR provision is applicable if your turnover is 1000 crores or more in the preceding financial year, or your net worth is 500 crores or more in the preceding financial year, or your net profit is 5 crores or more in the preceding financial year. Here in the given case, the turnover is less in all the three. Nothing about net worth is given, nor have they given us any means also to calculate the net worth. So that's not even possible. So that is also gone. But they have given a profit margin of 20%. Let's see what is the profits to understand whether CSR is applicable or not. 75% crores is my turnover, 20% is my profit margin. So 20% of 75 crores, right? 20% of 75 crores will be equal to how much? 15 crores. So in this first year, the profit is how much? 15 crores, right? 65 crores here. What is the profit? 20 by 100 into 65. 13 crores, correct? And in this year, 85 crores, how much is the profit? 17 crores. So does it apply? Yes, it applies. Obviously, it applies. So CSR will apply. That's for sure. Now, how much they have to spend? Okay, CSR provisions are applicable. Yes, they are applicable. But there was no requirement to constitute a CSR committee. And the above functions can be discharged by the board of directors themselves. If your expenditure does not exceed 50 lakhs, you don't have to constitute a CSR committee, right? And in that case, your the functions of the CSR committee can be done by the board itself. Here, if I see 2% of average of all of this, right? It comes to how much? 45 crores divided by 3, which is equal to 15 crores. Am I right? 15 crores, yeah. And 2% of 15 crores. I need to calculate. This comes to 30 lakhs. Since it is less than 50 lakhs, do I need to constitute a CSR committee? No. So they don't need to constitute a CSR committee, but obviously they have to what? They have to, CSR is applicable to them. So here you have to write all of those provisions of when is CSR applicable, the committee, the expenditure, when we don't have to have a committee, all of that. So the provisions will be actually a little huge. So of the Companies Act 2013, every company having a turnover of 1,000 crores or more, net profits of 5 crores or more, or net worth of 500 crores or more in the immediately preceding financial year shall constitute a CSR committee comprising of 3 or more directors, out of which one at least one must be an independent director where the company has what? Appointed one, right? Now, if company is not required to appoint an independent director, the committee shall comprise of any 2 or more directors, right? Clear? As per the rules, every company, including its holding or subsidiary, and a foreign company which fulfills the criteria of section 135 shall comply with the provisions of the section, right? Shall comply with the provisions of the sections. Every company to which the CSR applies shall spend 2% of its average of the net profits for the past 3 years for its CSR expenditure. Correct? Now, if the total expenditure under CSR does not exceed 50 lakhs, such company need not constitute a CSR committee, and the functions of the CSR committee shall be discharged by the board of directors. Clear? So this is my provision. I have already explained to you about the CSR committee, considering whether Shika is correct in the view as to non-applicability. Since the total expenditure of Chicago Incorporation is 2% of 2% of, let me check, 15, 13, 17. Which is equal to 30 lakh, which is less than 50 lakh, the company need not constitute a CSR committee, and the functions of CSR committee shall be carried by the board of directors. So with this, we are done with this. Moving to the next one. So this is a question from LLP. Manu and Romu are college friends and intend to do trading in musical instruments. They have met Mr. John and Miss Kate, who are non-resident Indian, and they have all decided to form an LLP under the name and style of Manu John LLP with an initial capital contribution of 1 lakh each. The LLP was incorporated and it wants to appoint Mr. John and Miss Kate as designated partner and consults you as a... Okay. Every LLP must have at least 2 designated partners. Designated partners shall be individuals of which at least one should be a resident of India. Resident of India means a person who has stayed in India for at least 120 days during the financial year. Here, they want to appoint Joan and Kate as a designated partner. None of them is a resident in India. So, they can be appointed, but along with them, at least one person should be appointed as a designated partner who is a resident in India. So, this appointment is not valid, at least one other partner who is a resident should be appointed. So don't write LLP Act, right? Every LLP must have. LLP is a super important chapter. 10 marks straight away from this chapter you will get. But it makes your paper so easy. This 10 marks you're bagging. So never ever skip this chapter. Make sure that you are doing the chapter. Every LLP must have at least 2 designated partner. Such designated partner shall be individuals of which at least one should be a resident of India. Resident of India means a person who has stayed in India for at least 120 days during the financial year, right? So, as per this, both appointment of both who is appointed? Joan and Kate as designated partner is not valid as at least one of them must be a person resident in India. So, at least one of the residents should be appointed as a designated partner. Yes. So with this, we are done with this question. Moving on to the next one. Oh, this is a question from auditor has popped in between. So, Messrs. AT and Company is a proprietary firm, and Messrs. VK Associates a partnership firm, has been appointed as a joint statutory auditor of PQR Limited for 5 consecutive years. The shareholders have delegated the responsibility to fix the auditor's remuneration to the managing director. Can I actually ask my managing director to fix the remuneration? Well, when the auditor is appointed by the shareholders shall fix the remuneration, or the remuneration may be fixed in any other manner as may be specified. So if the shareholders have delegated the power to the MD to fix the remuneration, that can be done. Right? On 29/3/23, there was a change in the constitution of Messrs. AT and Company from proprietorship to a partnership. Messrs. AT and Company. Okay. In light of the above, does the company have the authority to delegate the power? This we already discussed. Whether annual ratification is necessary since the auditor is appointed for a consecutive period. Now, once the auditor is appointed, he holds office for 5 years. And we don't have to ratify his appointment every year. In fact, if you will ever see the notice of the annual general meeting, they don't even put that item as an item of business to be discussed in the meeting. Why? Once appointed, that appointment goes on for 5 years. So we don't have to reappoint them every year, right? So, no notification is needed. Whether revised ADT1 form is required to be filed with details of the new firm, Messrs. AT and Company, after the change in its constitution. So basically, ADT1 is filed whenever we appoint an auditor. So when the company appoints an auditor, it has to file ADT1 with the registrar, right? Now, when the constitution of the firm has changed, it's an altogether new form of business now. So yes, in that case, ADT1 has to be filed all over again, right? So let's just discuss this. Let's write. Just guys, give me 1 minute though. So starting with this answer. So first we'll have to write about the remuneration part, since that's the first question. So as per section 142 of the Companies Act 2013, the remuneration of an auditor appointed by the shareholders shall be fixed by the shareholders or in any other manner as may be prescribed. So, therefore, the company can delegate the power to fix the remuneration to the managing director. Correct? Now, under section 139, when the company appoints an auditor at the general meeting, such auditor shall hold office from the conclusion of that meeting to the conclusion of the 6th AGM. Such appointment need not be ratified at every AGM. Therefore, company need not ratify the appointment, right? Then moving forward, whether a revised ADT form, yes. In case there is a change in the constitution of the firm, the company shall treat it as a new appointment. In case of any appointment of the auditor, the company must file ADT1 with the registrar. Therefore, company must file ADT1 on the reconstitution of the form. Okay. With this, we are done with this one. Moving on to the next question. A, B, C, D are partners of Alpha LLP and have an equal share in the profit and losses of the LLP. A has made an agreement to transfer 70% of his share in the profits to his daughter X. He is transferring his shares, that is assignment, correct or not? Yes. X wanted to assess the information about the trading transactions of Alpha LLP claiming that she's entitled to the information as she receives a percentage of profit. Just because I have assigned the rights of my LLP to any other person does not make that person a partner of the firm. When it comes to right to access the books of accounts only, so this is basically based on assignment. A partner can transfer or assign his rights of profits in any LLP to any person. On such assignment, neither is it a dissolution of the LLP, nor is it that the assignee becomes the partner. Neither of this happens. Neither the assignee becomes a partner, nor can the assignee is it winding up. Since the assignee does not become a partner, he will not have the rights of a partner. Right to check the books of accounts is only with a partner. So the assignee cannot check the books of accounts. The partners refuse to grant her access. Does X have any remedy against the denial? Are the partners correct? The partners are absolutely correct and X will have no remedies against the denial, right? So here we have to write about assignment only. So as per section 42 of the LLP Act, right? 1 second, guys. As per section 42 of the LLP Act, the rights of a partner to a share of the profits or loss of the LLP and to receive distribution. If you don't even want to write, all of this, you can just write to the share in LLP, right? Can be transferred to any other person as per the terms of the LLP agreement, right? Such transfer of right, right? Such transfer of right does not result in the dissolution of LLP, nor does it result in the assignee becoming the partner. Okay. Since the assignee does not become the partner, he shall not have any right to participate in the business or access the books. Therefore, we can say, therefore, the partners are right in their refusal since the assignee is not a partner. Mr. L was employed as a fashion designer. Oh my God, there's one question which I wanted to discuss, which was a very, very interesting question also. I don't know how I left that out. Okay, Mr. L was employed as a fashion designer to Elegant Textile Limited. Just give me 2 minutes, guys. The mosquito repellent. Okay, so Mr. L was employed as a fashion designer in Elegant Textile Limited, a public limited company in Gurugram, India. During the financial year 23-24, he had efficiently provided his services for 183 days during the above said period. On 1/4/24, Mr. H, the human resource manager of Jeff Fashion Limited, Paris, offered him a better employment opportunity in such company. On 2/4/24, L left India for taking up employment as a production controller at Jeff Fashion Limited in Paris. Okay. In the year 23-24, he stayed in India for 183 days. Okay. 1/4/24, he got a job offer, and on 2/4/24, he left India for taking up employment in Paris. So, who is so they are basically, obviously we can make out the question relates to person resident in India. Who is a person resident in India? If a person has stayed in India for more than 182 days in the preceding financial year, immediately preceding financial year, and in the current financial year, he has not left India for taking up employment outside India or for any other vocation or office or any other reason where the stay is indefinite. That means if he has stayed in India for 183 days, more than 182, that is 183 days in the immediately preceding financial year, but in this year he takes up a job outside India, we will not consider him as a person resident in India, even though he has stayed in India for 183 days. So, two things are there for a person resident in India. He must have stayed in India, right? This is stay in India for more than 182 days in the preceding financial year. This was for the preceding financial year. And in the current year, he has not gone out of India for employment, right? Or vocation or any other purpose where the stay is indefinite. Correct? So, these two things have to be present. Here, first thing is present. He was present in India for more than 182 days in the preceding financial year. But in the current year, he left India for taking up employment. So can I say he is no longer a pre, he is now a proi, correct? On 34/24, he flew back to India for a 10-day family function. He did not come back permanently. He just came back for a 10-day family function. On his return, so first of all, the residential status of L. On his return to attend the family function, doesn't matter. He is a person resident outside India. He's a proi. Why? Because he has left India for employment, and the moment you leave India for employment, you become a proi. In case, instead of vacation, he joins an employment in India after arriving on 34/24. If after arriving he takes up a job, then in the preceding financial year he has already stayed for more than 182 days, and in the current year he is not leaving India. So then yes, but ma'am, he left India. This is the beauty of FEMA. It is every day your residential status changes. If you had gone outside India, you became a proi. But if you come back in India, you become a pre. So here again, since he has taken up a job, he becomes a pre. So when we talk about person residential status, what do we mean by as per section 2 of the FEMA Act 1999? A person resident in India means a person who has stayed in India for more than 182 days in the preceding financial year and does not leave India in the current financial year for any of the following purpose. What is the following purpose? What is the following purpose? For taking up employment outside India. right, for taking up employment outside India, or carrying on outside India any business or vocation, or for any other purpose where the stay is indefinite, right? So this is it. I hope this is clear to all of you. And we have already discussed the answers for both of the cases. Moving on to the next one. Heavy Loaders Limited is a public limited company incorporated in India and engaged in the manufacture of loader vehicles used for commercial construction purposes. It is planning to expand its business outside India and hence has come in contact with Mr. Fred, an American citizen working as an agent of companies planning to secure business in US. Mr. Fred has informed the directors that another Indian company engaged in commercial construction business has requirement of 25 loaders has a requirement of 25 loaders vehicles for its wholly owned American subsidiary company. Heavy Loaders Limited supplied the required loader vehicle with an invoice value of USD 3,50,000 in exchange of allotment of equity shares of the same worth in the American company. They have asked for a commission of 15% of the invoice. See here, what has happened is he has taken up equity capital, correct? He has taken up equity capital. So basically, you are investing in that entity, correct? In that case, when it is your, what you say, when it is a joint equity, right? In that case, when it is a joint venture or a wholly owned subsidiary, in that case, commission is not allowed to be paid. Let's read the question again. Heavy Loaders Limited Incorporate engaged in the manufacture of loader vehicles used for commercial construction purpose. It is planning to expand its business outside India and hence has come in contact with Mr. Fred, an American citizen working as an agent of companies planning to secure business. Mr. Fred has informed the directors of Heavy Loaders that another Indian company engaged in the commercial construction business has a requirement of 25 loader vehicle for its wholly owned American subsidiary company. When you are paying commission for your joint venture or wholly owned subsidiary, commission is not allowed to be paid. Okay? Heavy Loaders Limited supplied the required loader vehicle with an invoice value of USD 3,50,000 in exchange of allotment of equity capital in the American company. Mr. Fred has asked for an export agent commission of 15%, not allowed, of the invoice value of the goods supplied, to which Heavy Loaders Limited has refused the payment on the grounds that maximum commission can be paid up to 10% of the invoice value. Okay? It's not allowed, it's prohibited. Considering the provision, whether it's an export, anything when you send it outside India, it is considered as an export, correct? Then, whether the rate of export agent commission demanded by Mr. Fred be paid or confined to only 10%. Since it is prohibited, it is not allowed, so he cannot be paid any commission. Okay? He cannot be paid any commission. So here we are supposed to write two things. First, we have to write the definition of export. Since it's a very direct answer, you just have to write the definition. I'm not writing that. However, you have to write about, as per Schedule 1 of the current account transactions, you are not allowed to give any commission on any, on any equipments to be provided to your joint venture or wholly owned subsidiary. So here paying this commission is prohibited under Schedule 1. So they cannot pay any commission. Mr. P has won a big lottery and wants to remit US dollar 20,000 out of his winnings to his son who is in the US. Again, when we talk about current account transactions, we have three things here. One is prohibited, one is where I need the approval of central government, another is where I need the approval of the RBI, right? Here, lottery is something which is prohibited. So, whether this is possible? No. Under FEMA current account transaction rules, it is prohibited for a person to remit the lottery expenses. So this is not allowed. So this is cannot be done, right? When we talk about current account transactions, we have three. One is prohibited, one is approval of central government, one is approval of RBI. This is prohibited. Mr. Z is unwell and would like to have a kidney transplant done in the US. He would like to know the formalities required and the amount that can be drawn. So here for current account transaction, you can draw up to USD 2,50,000. You can even draw beyond that if it is under the liberalized scheme, liberalized remittance scheme. So here what he can do is he can actually get a, what do you say, a whole, chalk out a plan of how much expenses would be there, and accordingly he can get the approval and he can spend even more than 2,50,000 with the approval. So here there is no restriction. He can go forward up to USD 2,50,000 absolutely without any restriction. Beyond that, he can get a budget from his doctor for the expenses and he can get the approval. Okay, now we are going to the next one. Mrs. Neelu Chandra was a director in Laddu Sweets Private Limited. Once, while dealing with the supplier of raw materials for the company, she agreed to get some secret commission from the supplier for making the deal. Afterwards, on finding the facts, the company has filed a suit against Mrs. Neelu Chandra. She contended that Section 166 of the Companies Act provides a director of a company shall not achieve or attempt to achieve any undue gain or advantage either to himself or to his relatives. She contended that it's applicable to male directors only, and she being a female will not be liable. So we already know what our General Clauses Act says by virtue of Section 13, where Section 13 says that the male gender shall include the female gender unless specifically provided otherwise. The male gender shall always include the female gender, and similarly for singular and plural, the singular shall include plural and vice versa, right? So as per Section 13 of the General Clauses Act, unless a different intention appears, the male gender shall include the, or rather, in every central act or regulation. General Clauses Act is one chapter. You will get it for at least 8 to 10 marks. Easy chapter, should do it. Or regulation, the word importing the male gender shall be deemed to include the female gender. So she being a female will not be liable. Her contention is not right. She will also be liable because male includes female. So moving on to the last question, the 30th question. A series of law comes to an end with this. Mr. Mike had lent his house property to Mr. Wise at a monthly rent of 15,000 per month. The yearly rent agreement was due to expire in the near future. However, Mr. Mike does not intend to continue this agreement and he has sent a notice to Mr. Wise for the termination of the agreement. Mr. Wise, on the other hand, does not want to vacate the property and has hence returned the notice with an endorsement of refusal. Whenever a document is sent, and this document, if it is properly stamped, properly addressed, and it is sent by the registered post, it is deemed to have been served. If the document has been served and it is returned with an endorsement of refusal, it will be deemed that the document has been served. Discuss whether the notice was served to Mr. Wise. Yes, here it will be deemed that the notice has been served to Mr. Wise. So, as per section 27 actually talks about, service of post. So, as per section 27 of the General Clauses Act, right, where any legislation requires the any document to be served by post, such document is deemed to have been served by post if it is properly addressed, properly stamped, and sent by registered post. In Jagdish Singh versus Nathu Singh, that was the case, same thing had happened in that case. It was held that where a notice is sent to the tenant by a registered post and is returned by the tenant with an endorsement of refusal, the notice is deemed to have been served. So here can we say the notice has been deemed to have been served? Yes. With this, we are done with our 30 super 30 questions. I hope your studies are going on well, and I hope you're continuously studying, moving on towards your goals. Keep studying, stay motivated, don't lose the track, and happy learning and stay motivated. I hope all the success for you, all the best. Thank you so much.